Most people think the biggest threat to their retirement income is a major benefit cut, announced on the evening news. But the reality is that the biggest changes rarely arrive. That way, they happen quietly. A new recovery rule here, an inflation adjustment that doesn't keep pace with real expenses there, a filing requirement that seems small until it changes what lands in your bank account each month. If you're retired, approaching retirement, or planning to claim Social Security within the next few years, these quiet changes deserve your attention, not because they're designed to create panic, but because they can change your monthly cash flow in ways many households don't notice until after the money is already missing. The good news is that most of these situations can be managed if you know where to look and what to do before they affect your finances. Once you see the numbers clearly, you'll understand why this matters more than most people realize. One of the biggest misconceptions about Social Security is that your monthly benefit is fixed. Once it begins, in reality, your benefit is connected to a much larger financial system. Tax laws change, cost of living adjustments change, Medicare premiums change, rules change, income thresholds change, and while each adjustment may appear relatively small on its own, together, they shape the amount that actually reaches your checking account. That's why so many retirees say the same thing every year. They expected their benefit to increase, yet somehow it still feels like they're falling behind. This isn't always because Social Security is shrinking. Often, it's because other costs are quietly growing around it. Let's start with what many retirees notice first: their monthly deposit. Every year, Social Security benefits typically receive a cost of living adjustment, or COLA, intended to help benefits keep pace with inflation. But here's where context matters. Inflation isn't experienced equally by every household. The average inflation rate may suggest prices have stabilized, but retirees spend a larger share of their income on healthcare, housing, prescription medications, insurance, and utilities. These categories often rise faster than the overall inflation number. Imagine two households receiving the exact same COLA increase. One household has a paid-off home and few medical expenses. The other rents an apartment, pays Medicare premiums, fills multiple prescriptions, and faces rising homeowner or renter insurance costs. On paper, both households received the same raise. In reality, one feels financially stable while the other experiences a decline in purchasing power. That's the difference between averages and lived experience. Now let's look at another quiet change that's receiving more attention. Over the past few years, the Social Security Administration has placed greater focus on recovering benefit overpayments. An overpayment can happen for several reasons. Sometimes a beneficiary forgets to report income changes. Sometimes paperwork is processed late. In other cases, administrative errors contribute to incorrect benefit amounts. Regardless of the cause, if an overpayment is identified, the agency may seek repayment. For many retirees, the surprise isn't that repayment is required. It's that they didn't realize an issue existed until they received a notice. This is where most people get caught. The assumption is that if the government made a mistake years ago, nothing can be done. But that's not always true. Depending on individual circumstances, beneficiaries may have options to request reconsideration, appeal certain determinations, seek repayment arrangements, or request a waiver if specific eligibility requirements are met. The key lesson isn't that everyone will qualify for relief. It's that ignoring the notice removes options that may have existed. Timing matters. Understanding the process matters. Responding quickly matters. Now let's shift to something even broader. There are two types of retirement households beginning to emerge across America. The first group reacts after financial changes happen. Their Medicare premium increases before they review their healthcare costs. Their Social Security deposit changes before they log into their online account. Their required tax documents arrive before they think about withholding. Every financial decision is reactive. The second group operates differently. They schedule annual benefit reviews. They verify earnings records. They monitor tax withholding. They build emergency savings specifically for unexpected healthcare or housing costs. Neither group can control government policy, but one group consistently adapts faster because they review their financial picture before changes become problems. That difference compounds over time. A few $100s saved each year may not sound life-changing, but over 10 or 15 years, avoiding unnecessary penalties, reducing taxes, managing withdrawals efficiently, and adjusting spending can preserve thousands of dollars that would otherwise disappear quietly. Here's another area that deserves attention. Many retirees focus entirely on the size of their Social Security benefit, while overlooking taxes. Depending on total household income, a portion of Social Security benefits may become taxable. That doesn't mean everyone pays tax on Social Security. It means the interaction between retirement income sources matters. Withdrawals from traditional retirement accounts, pensions, part-time employment, investment income, and required minimum distributions can all influence the overall tax picture. This is the part almost no one talks about. Sometimes earning an additional few $1,000s doesn't simply increase income. It can increase taxable benefits, Medicare premiums, or move part of your income into a different tax situation. That's why retirement planning isn't only about generating income, it's about managing how that income flows. Let's make this practical. If you're in your early 60s and thinking about claiming Social Security, understand that claiming age affects monthly benefits for the rest of your retirement. The decision isn't only about today's income, it's also about your expected longevity, your health, your spouse's situation, and other retirement assets. If you're already receiving benefits, make reviewing your annual Social Security statement part of your financial routine, confirm your payment amount, verify Medicare deductions, and review any notices promptly instead of setting them aside. If you're between 50 and 60 and still working, this is an ideal time to estimate future retirement expenses rather than assuming current spending patterns will continue. Healthcare, housing maintenance, insurance, and inflation deserve realistic projections. If you're carrying high-interest debt into retirement, reducing that balance may improve monthly cash flow more than chasing higher investment returns. Every dollar not paid in interest becomes a dollar available for living expenses. And if you're helping adult children or grandchildren financially, be careful not to compromise your own retirement security. Generosity is admirable, but sustainable generosity starts with protecting your own financial foundation. So what can you actually do this week? First, log into your Social Security online account and verify that your personal information, earnings, history, and benefit details are accurate. Small errors are easier to resolve early than years later. Second, review your monthly budget using today's prices rather than last year's. Assumptions, rising insurance, healthcare, and utility costs deserve updated estimates. Third, calculate how many months of essential expenses you could cover if an unexpected bill or temporary benefit issue occurred. Building even a modest emergency reserve can reduce financial stress dramatically. Fourth, review your tax withholding strategy. If your retirement income has changed, it may be worth discussing withholding adjustments with a qualified tax professional before the end of the year. Fifth, evaluate recurring subscriptions, insurance policies, and service contracts. Quiet spending often grows just as quietly as inflation. Finally, schedule one financial review every year. Not because you expect problems, but because consistent reviews help prevent small issues from becoming expensive ones. The households that build lasting financial security rarely succeed because they predicted every policy change. They succeed because they created enough flexibility to adapt. That's the real lesson behind today's discussion. Financial stability isn't built by reacting emotionally to every headline. It's built by understanding the rules, reviewing your finances consistently, and making thoughtful adjustments as circumstances evolve. The strongest retirement plans aren't perfect. They're resilient. There will always be new regulations, updated benefit calculations, changing inflation rates, shifting tax rules, and evolving healthcare costs. Those changes are part of retirement. The households that navigate them successfully aren't necessarily the wealthiest. They're the ones paying attention before small changes become large financial surprises. So before you leave today, take a moment to ask yourself one question. If your monthly retirement income changed by just 5% tomorrow, would you know exactly why? I'd genuinely like to hear your answer in the comments, because your experience may help someone else prepare for their own retirement journey. And if you enjoy clear, fact-based conversations about Social Security, retirement planning, taxes, and personal finance without unnecessary hype, consider subscribing every week. We break down the financial changes that matter most so you can make decisions with confidence, not confusion.